Hey there, welcome back to our channel. Today, we're diving into an interesting topic that affects our wallets and the economy, the relationship between the housing market and inflation. So, if you're curious about how these two things are connected, stick around. Let's start with the basics. Housing costs, which include rents and home prices, are a big part of our expenses. When these costs rise, they can contribute to overall inflation. Imagine you're in a situation where more people are looking for homes than there are homes available. This increased demand can lead to higher prices, and guess what? That can show up as a bump in the Consumer Price Index, which is a measure of inflation. But here's the twist. Central banks like the Federal Reserve tinker with something called interest rates to control inflation. When they feel inflation is getting too hot, they might raise these rates. And why does this matter for housing? Well, when interest rates climb, borrowing money becomes more expensive. That includes getting a mortgage for a home. With pricier mortgages, fewer people might be able to afford homes, which can lead to a dip in housing demand. And that dip can ultimately put a check on rising home prices. In June, the leader of the Fed, Jerome Powell, talked about making changes to the housing market. This might cause home prices to go down. After this, experts discussed whether Powell's use of the word reset was a good idea. Quote, Powell explained, "When I say reset, I'm not looking at a particular specific set of data. What I'm really saying is that we've had a time of a red-hot housing market all over the country, where famously houses were selling to the first buyer at 10% above the ask, even before seeing the house. That kind of thing. So there was a big imbalance between supply and demand. Houses were going up at an unsustainable fast level." Now the housing market reset is a term that's been buzzing around, especially after being mentioned by influential figures like Jerome Powell. But what does it really mean? Essentially, it's about making some changes to how the housing market operates. These changes are meant to address some issues that have been building up, particularly when home prices have been skyrocketing. Okay, but what's causing the need for this reset? Imagine this. There's been a period where lots of people are eager to buy houses, but the number of available houses hasn't kept up with the demand. This leads to a kind of imbalance where prices shoot up quickly, which isn't sustainable in the long run. The reset is all about finding a better balance between the number of houses available and the number of people who want to buy them. As the Fed has increased how much it costs to borrow money, the housing market has started to slow down. The reset, or housing correction, is meant to spread through the economy and bring down the increase in prices. When the cost of borrowing money for a home goes up, fewer people buy homes. This also makes people buy fewer long-lasting things and services, which then makes the job market weaker and helps control the increase in prices. Quote, Powell continued, "For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level and at a reasonable pace, and that people can afford houses again. The housing market has to go through a correction to get back to that place." Even though Powell wants to bring the housing market into better balance, the strong effort could make building new homes decrease. This might cause there to be even fewer homes available, which is the opposite of what was planned. Quote, Powell said, "As you know, it is difficult to find lots now close enough to cities, so builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a business cycle standpoint, this difficult housing correction should put the housing market back into better balance." If you found this video helpful, don't forget to hit that thumbs up button and subscribe for more insights on economics and finance. Thanks for watching, and we'll catch you in the next one.